Private debt and equity firms have been raising record amounts of money in the past few years. We talk a lot about that. And now a growing number of investors are talking about democratizing the market. Can we start with what does that mean? Does that mean that everybody with a retirement fund is going to have private equity exposure?
Hi, Lisa. No, it's a very good question, and this is a topic that's been it's been top of mind for a lot of investors for several years now. And the primary reason is because private equity markets consistently outperform the public markets. And if you look at it over a 10 or 15-year horizon, you have an asset class that's generating very strong returns that has traditionally only been available to large institutional investors. And so I think there are a number of voices out there in the market saying we should provide access to these types of returns as well as this asset class in general to your general mom and pop investors. And so I would say that on the more retail side of things, there is a push to make this asset class available, but there's also a lot of risks involved with it as well.
Yeah, I was just going to say, I mean, a lot of people think that the best returns of private equity are gone. And the question of liquidity, right? The idea of people looking to be able to withdraw their money from retail funds and the inability to do that when it comes to private equity. I mean, how much of a risk is that? Do you see that as being an impediment, or people will just shrug that off?
I do see it as a risk. And so, look, I think that this is something that is coming, but this is not something that will take hold in the market in 2020 or maybe even in the couple of years subsequent to that. I think that you have issues around pricing, like liquidity, as you mentioned. But at the same time, I think that with more businesses staying private for longer, as well as outperformance in private equity. And look, I will agree with you that returns are compressing there, but you're still, over the long term, are going to generate outperformance when you do compare to the public markets.
Elizabeth, I want to shift gears a little bit to the dry powder that we've seen, because we've seen record amounts of dry powder accumulate. And I'm wondering, first of all, does this mean that private equity companies don't know what to do with their money?
No, I don't think that it means that. But I will say we've got about 1.2 trillion in dry powder that is that's in the market today, and that capital, it will get tranched into the market over time. And so private equity sponsors are raising capital and then they are investing it over a 5 to 6 year investment period. And so you have to think about it kind of coming into the market in, kind of in a more measured pace. And I would say the capital overhang is, it's a function of, I'd say quicker fundraising timelines. And so it's taking less time to raise capital, as well as larger funds getting raised. So I wouldn't say that there's a problem in putting the dollars to work. The money's just getting raised and put to work more quickly.
Okay, you say it's getting put to work. I'm wondering if the money is not put to work, are any firms returning the capital or not? If they're not drawing on it to a certain degree, where does it go? Where does the money sit?
It's an interesting question. So I would say that we do not see issues in sponsors putting the money to work. There are ways where they can request extensions and give themselves a little bit of extra time to put that money to work. There are times when they could release commitments back to investors, but generally speaking, we're seeing a pretty healthy marketplace, and I don't think that there are issues in getting dollars out the door.
I would love your perspective on something Randy Schwimmer was talking about, which is the first quarter and being a really active one. Do you also see that people are going to try to get ahead of the 2020 elections in the United States and get deals done early?
So I would say within our portfolio at Barings, we're seeing a lot of deal activity, and we're seeing a lot of really interesting opportunities. I don't think that there's a rush to put capital out the door to mitigate any sort of future political risk. This is a long-term asset class. Money is getting put to work for a long time. And so if you invest the capital in January versus investing the capital in November, I don't know if that it makes much of a difference. I will say political risk is something that's getting talked about a lot lately. And so I think that as we look at deal flow and as transaction activity happens, I would say that amount of risk is probably getting priced in. So I don't see people rushing to put money out the door just to kind of avoid certain political pitfalls.
Elizabeth, just real quick here, is your sense that a lot of private equity firms are expecting some sort of downturn or down cycle next year?
So if I knew the answer to that question, then I'd be in a different situation. But I would say that we at Barings are talking about the fact that we're late in the current economic expansion. We're late cycle. We're seeing a lot of typical late cycle behavior that's happening when it comes to things like purchase price multiples, when it comes to leverage multiples. So I think that everybody is preparing for some type of downturn, but we're not quite sure when it's going to be. And so we have to think about where we're investing the money. And so we're seeing interesting opportunities in more defensive industries, and we're hearing the words, recession resilient a lot more as we're out in the market and we're seeing deal flow.